Have you ever wondered what is the best strategy to give away money? Now, look, we all know that giving away money is about the heart. It's not about the tax deduction. But I've also never met anybody that wants to give more money to the IRS and less money to their favorite charity. Hey, everyone, I'm Jacob Turner, former Major League Baseball player and current co-founder of Moment Private Wealth. In today's video, we're going to talk about just that. Something that I discovered almost 10 years ago that would have saved me a lot of money if I would have discovered it just a little bit sooner. Today, we're going to talk about how to donate money and really what is the best way to do it, and one specific tool that we recommend to almost every single one of our high net worth clients that can help them save more money on taxes and get more money to their favorite charity. Make sure you stay till the end, because at the end, we're going to show a visual of what this looks like for it to really sink in. Before we talk about my favorite account for donating money and how you can use it just like I've used it in the past, I want to understand the biggest misconception that people have. When we donate money, typically we think, or at least I thought, okay, if I donate money to this charity, that means I get a tax deduction. Well, on the surface, that is true. Oftentimes, that doesn't actually play into reality. And let me explain why. Today, the standard deduction is bigger than it's ever been. For a married couple, it's $29,200. That means for an individual, it's $14,600. So let's use a hypothetical example. We have taxpayer one over here, and taxpayer one says, I don't have any charities that I want to donate to this given year, so they don't do any charitable donations, and they just take the standard deduction. They're married, so they take a $29,200 deduction. Taxpayer two says, there's this charity that I really want to give to. I'm going to give $10,000 this year, a lot of money. And they're thinking, well, I'm going to get an additional tax benefit for giving away my $10,000. Well, it turns out they don't actually have enough deductions to take anything more than the standard deduction, because their $10,000 gift is actually still lower than the $29,200 standard deduction. So that means that although taxpayer one gave away no money and taxpayer two gave away $10,000 in that given year, they both got the same deduction on their tax return. And that's the biggest misconception when it comes to giving away money, is that just because you give away $1 doesn't mean you're getting a tax deduction. So we got to think a little bit more strategically about it. And the way for us to think more strategically about this is to really use what's called a donor advised fund. So a donor advised fund, or some refer to it as a DAF, D-A-F, is a type of account. That's all it is a type of account where you can bunch donations together. So remember, let's think about our scenario we just talked about. Taxpayer one donated nothing, taxpayer two donated $10,000. Well, the question that I would ask taxpayer two is there going to be future donations in the future? And if they would have said, on average, we really give away about $10,000 a year. A donor advised fund could have been a great solution for them, because this is all a donor advised fund is in theory. And I want you to take a look at this visual here. So what we're looking at here is this is a visual diagram of what a donor advised fund is. Remember, we were just talking about our taxpayer one versus our taxpayer two scenario. If we use our same $10,000, if instead of just using it in 1 year, we said, okay, we're going to give away $10,000, and we strategically thought about planning ahead, and we decided to really group our donations together, this is how a donor advised fund can really come into play and can really help you. So if you take a look over here at yearly donations, we have our $10,000 yearly donation, but if we group those together, we're still giving away $10,000 in our given year. But our total donation in that first year, instead of it being $10,000, is actually $40,000. Now, before you get concerned and say, I don't want to give away $40,000 this year, you don't have to. Now, we have to put $40,000 in our donor advised fund, but that doesn't mean we actually have to grant it to it in that given year. So if we take a look down here, here's the dynamics of how this actually works. We have our contribution here. So that means our $40,000 goes in. Now, the IRS treats that as a full tax deduction in that given year. So we'll use the example. We put in $40,000 in this given year, we get a tax deduction of $40,000. Now remember, our standard deduction is $29,200. So our $40,000 number is higher than that. So we're actually getting an additional tax benefit for those dollars. Then what happens? A donor advised fund is just an account, and you can actually invest that account. So that means the account has the optionality to continue to grow. You still haven't actually granted any money to a charity yet. You've just gotten the tax deduction, you've thought strategically about it, and now you're investing the money. Okay, a win-win-win. And then you say, okay, now I know I want to give away $10,000 this year to the charity of my choice. And you make your grant. You can see over here, this is where the grant is actually made. Once the grant's made, your 501c3 charity gets the grant, just like you would have done in any given year. But because you thought strategically about it, you now have an additional $30,000 you can give away in the future. That's also invested and hopefully growing. You've also gotten a tax deduction of $14,800, as opposed to a tax deduction of $0 in this initial $10,000 contribution. So as a reminder, when we think about tax deductions, it's about the heart. But at the same time, we want to make sure that we're also maximizing our tax benefit. And that's where a donor advised fund comes into play. So here's a couple additional things that you need to be thinking about if you choose to use a donor advised fund. So now that we understand how a donor advised fund works, remember, this is just an account. It doesn't have to be fancy in your mind. It's just an account that you can group donations together and put more money in one given year and get a bigger tax deduction. So in theory, it's just a way for us to think more strategically about our gifting. But there's a couple things I want you to understand. When you put the money in a donor advised fund, you can't get it back because the IRS, in their eyes, they're saying you've actually donated that money. Now, while your charity of your choice hasn't actually received it yet, you can't just reach into your donor advised fund and pull it back out. That money is essentially given away. Secondarily, whenever money is given to a donor advised fund, it needs to be granted to a public 501c3 charity. What this means is any standard charity. But you can't go to your neighbor and say, I'm going to give you money out of my donor advised fund. It has to actually go to a 501c3 charity, which is designated by the IRS. A couple other things to think about is, depending on how much you want to give in a given year, maybe you sell a business, maybe you have a big contract and you say, I really want to give a ton of money away this one given year. There are some restrictions, okay? You can give away either 60% of your adjusted gross income in cash or 30% of your adjusted gross income if you were to give away stock. So there are some limitations there. So we need to think strategically about if we want to give away a lot of money in a given year or give away a lot of money over the next several decades, what is the best way to go about doing that? The third thing that I want you to think about, and I just touched on it there, was we always encourage our clients, if we can, we don't want to give away cash. We actually want to give away appreciated stock. So let me give you an example. Let's say we buy one share of Apple and our Apple share is worth $10 when we buy it. That Apple share grows over time and it's worth $20. Now, if we were to sell that Apple share, we'd owe $10 in capital gains. Remember, we bought it for 10, it's worth 20, $10 in capital gains in the middle. Instead, what we would say is, hey, if we want to give away money this year, let's give away our $20 stock in Apple. Because you know what happens then? We don't have to pay any capital gains. Our entire $20 position can go into our donor advised fund. Our taxes go away and we get the entire deduction on our taxes of the $20. So it's a win-win-win for you. You're able to give more to your favorite charity, you're able to give less to the IRS, and you're able to use potentially appreciated stock to do that. So if you're like me, you're always thinking about ways you can be creative with your taxes, and gifting is one of those ways. So remember, the next time you think about gifting, potentially use a donor advised fund. It's something that's worked really well for me and it's something that's worked for our clients. If you enjoyed this video, make sure you subscribe. I'm always putting out content about things that I've either done in my own life or I've learned about that I wish I would have known sooner. I hope this video helped you, and let's get smarter with our money together.